FICO score. For beginners, a simple guide. Does the term FICO score make your stomach do a little flip? Yeah, you're not alone. For way too long, it's been this mysterious 3-digit number that seemingly holds the keys to your entire financial life. Whether you get that car loan, approved for an apartment, or offered a credit card that doesn't have a scary interest rate, it can feel like it just appears out of nowhere, holding all the power. But what if I told you it's not a mystery? It's not some secret code. It's just a grade. A grade based on 5 simple things you can actually understand. In the next few minutes, we're going to break down all 5 parts of your FICO score in a way that makes sense. By the end of this, you'll know exactly what to focus on to build a great score. You'll be in control. Let's start with the biggest piece of the pie. Section 1, Payment History, 35% of your score. Alright, first up, and the absolute heavyweight champion of your score is your payment history, making up a massive 35%. Think of this as the foundation of your entire credit reputation. There's a simple reason it's the biggest part of your score. Lenders just want to know if you pay your bills on time. That's it. Your past behavior is the best predictor of your future behavior, and this is their report card on your reliability. This part of the score looks at all your credit accounts. Credit cards, student loans, car loans, mortgages, you name it. Are you paying on time? Have you ever been late? If so, how late were you? 30 days, 60 days or more? And how long ago did that happen? A single payment that's more than 30 days late can drop your score, and fast. On the flip side, a long history of on-time payments is the most powerful way to build a fantastic score. It proves to lenders that you're a low-risk borrower. So, how do you nail this 35%? First, pay every single bill on time. No exceptions. The easiest way to guarantee this is to set up automatic payments for at least the minimum amount due on every account. This is your safety net. It ensures you never accidentally miss a payment. You can always go in and pay more later, but that auto payment has your back. Second, use calendar alerts. Set a reminder on your phone a few days before each bill is due. It's a simple nudge to double-check that everything is ready to go. What if you mess up and miss a payment? Act fast. If you're just a day or two late, call the lender, make the payment right then, and politely ask if they'd be willing to waive the late fee and not report it to the credit bureaus. If you have a good history with them, many will cut you some slack for a first-time mistake. But once a payment is 30 days late, it's almost certainly getting reported. That's when the real damage happens. Mastering your payment history isn't about some complex strategy. It's about simple, boring consistency. Automate, set reminders, and always pay on time. Get this right, and you've already conquered the biggest part of your FICO score. Next up, accounting for a huge 30% of your score is amounts owed. Now, this isn't just about how much debt you have in total. The real focus here is on something called your credit utilization ratio. I know that sounds fancy and complicated, but the idea is super simple. It's the percentage of your available credit that you're currently using. In other words, how much of your credit card limit have you actually spent? Let's make it easy. Say you have one credit card with a $10,000 limit. If you have a $1,000 balance, your utilization is 10%. Easy. If your balance is $5,000, your utilization is 50%. So why does this matter so much? Because a high utilization ratio screams financial stress to lenders. It suggests you might be relying too heavily on credit to get by. Someone using 90% of their credit limit looks a lot riskier than someone using just 10%. The general rule is to keep your overall credit utilization below 30%. But honestly, for the best scores, you want to be under 10%. The people walking around with those top-tier 800-plus FICO scores, they often have utilization in the single digits. So here's how to manage this 30% chunk. First, don't even get close to maxing out your cards. It's one of the most damaging things you can do for this part of your score. Second, try to pay your credit card balances in full every month. When you do that, a low balance gets reported to the credit bureaus, and your utilization stays nice and low. If you can't pay it all off, pay as much as you possibly can. Third, here's a pro tip. You can lower your utilization without even paying down debt. Just ask for a credit limit increase. If your limit on that $10,000 card gets bumped to $20,000, your $5,000 balance instantly goes from 50% utilization down to 25%. Your ratio improves on the spot. Most credit card companies let you request an increase right in their app or on their website. And hey, a quick favor before we jump to the next point. If you're finding this useful, please take a second to hit that like button. It really does help the video get seen by more people who are trying to figure all this stuff out. The third factor, making up 15% of your score, is the length of your credit history. This one is all about time. Lenders feel much more comfortable when they see a long, established track record of you managing credit. A longer history just gives them more data to prove you're reliable. This category looks at the age of your oldest account, your newest account, and the average age of all your accounts combined. The older, the better. And this brings us to a huge, costly mistake a lot of people make. They pay off an old credit card and think, great, I'm done with this, and they close the account. Please do not do this. When you close an old credit account, two bad things happen. First, you erase that account's age from your history, which can drag down the average age of all your accounts. If it's your oldest card, the impact can be significant. Second, you also lose that card's credit limit. This means your credit utilization ratio, that super important thing we just talked about, can shoot right up, even if you haven't spent another dime. Imagine you have two cards, one you opened 10 years ago with a $10,000 limit and no balance, and a new one from last year with a $5,000 limit and a $2,500 balance. Right now, your credit history looks long and your utilization is low, but if you close that old card, boom, your average account age tanks, and your utilization suddenly jumps to 50%. You've hurt your score in two ways with one move. The strategy here is simple. Keep your old accounts open, even if you don't use them. Put a small recurring bill on there, like Netflix, and set up autopay. This keeps the account active and lets it continue to age gracefully, helping your score. Patience is the name of the game here. Coming in at 10% is your credit mix. This factor is less about how much you owe and more about what kind of debt you have. Lenders like to see that you can successfully handle a few different types of credit. Generally, there are two main types of credit. Revolving credit. This is stuff like credit cards. You have a limit, and you can borrow and repay over and over. Installment loans. This is a loan for a fixed amount with a set repayment schedule. Think car loans, mortgages, or personal loans. You get a lump sum and pay it back in equal chunks over time. Having a healthy mix of both shows lenders you have broad experience. It proves you can handle a steady monthly car payment just as well as you can manage the flexibility of a credit card. Now, this is really important. You should never take out a loan or open a new account just to try and improve your credit mix. That's just silly. It would trigger a new inquiry and lower the average age of your accounts, which would likely hurt your score more than help it. Instead, this part of your score tends to take care of itself over time. You might start with a credit card in college, get a car loan a few years later, and eventually, get a mortgage. As you naturally add these different accounts and pay them on time, this part of your score will improve all on its own. Finally, the last 10% of your score is all about new credit. This looks at how recently and how often you've been applying for new credit. Every time you formally apply for a loan or a credit card, the lender does a hard inquiry on your report, which often causes a small, temporary dip in your score. Why? Because applying for a bunch of new accounts in a short amount of time can be a red flag. To a lender, it might look like you're in financial trouble and are desperately trying to get cash, which makes you seem like a higher risk. The key is to be strategic. Don't just apply for a dozen cards to see what you can get. Each application can knock your score down a little, and those small hits can add up. However, the scoring models are smart. They know that you'll shop around for the best interest rate on big loans. If you're looking for a mortgage or a car loan, the formula typically groups all related inquiries within a short period, usually 14 to 45 days, and treats them as a single event. This lets you compare offers without wrecking your score. So just be mindful, only apply for credit you actually need, and when you're rate shopping, get it all done in a tight time frame. So, let's recap. That big scary FICO score is really just a grade based on 5 things. Payment history, 35%. Pay your bills on time, period. Amounts owed, 30%. Keep your card balances low, under 10% is the goal. Length of credit history, 15%. Keep your old credit cards open, don't close them. Credit mix, 10%. This builds naturally, don't force it. New credit, 10%. Don't apply for everything at once. Be strategic. That's it. That is the formula. your payment history, and how much you owe make up 65% of your entire score. If you can just master those two things, you're already on the fast track to an excellent score. Your FICO score is not a permanent tattoo. It's a living number that you have the power to influence. By understanding these 5 factors, you've taken the most important step toward owning your financial future. Thanks so much for watching. If this guide helped clear things up for you, please subscribe for more simple guides on personal finance. And now I have a question for you. What's one credit goal you have for this year? Drop it in the comments below. Let's start a conversation and learn from each other.